Hi, everyone. This is Jason Birak of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. I'm excited. We have a first-time guest on. I've spoken to him in emails, and I met him a number of months ago. He's very well known in the gold and silver community. He's been affiliated with GATA, and he has a very intuitive following there of the derivatives markets, of interest rates, and what the banks have been doing. His name's Rob Kirby of Kirby Analytics. Thank you for joining us here today, Rob.
Nice to be with you, Jason and Mo.
Hey, Rob, we want to start off the podcast talking about the banks and the financial state that they're in right now, because there's a lot of people that cannot even interpret the financial statements for these banks because there's so much off-balance liabilities and it's a lot very complex just to try to value their so-called assets because these banks have a lot of derivative exposure, which we'll talk about later. So I want to talk about the banks and what you think, why do you think the banks are being able to, stay alive for this long after the 2008 financial crisis, other than the fact that the Federal Reserve are bailing them out?
Why the banks are allowed to stay alive is they basically act as agents for the U.S. Treasury, specifically for the Exchange Stabilization Fund. So the trillions upon the tens of trillions of dollars the big derivatives banks have on their books are their chief counterparty is the Exchange Stabilization Fund in the United States, which is a piece of the U.S. Treasury, and they in effect are the conduits through which U.S. monetary policy is implemented. So it's in the U.S. Treasury's interest to keep these banks alive, and therefore I would say the odds of any of these major banks actually doing a face plant or declaring bankruptcy is about the same likelihood as the U.S. Treasury declaring insolvency and a default.
Now, Rob, it seems the rules of the game changed in that regard after 2008. Maybe Lehman was sacrificed to show the system that it can't fail, or to prove to the public then that we have to have more bailouts, we have to have this money printing, we have to let the banks be able to do the stuff with the derivatives or whatever they want. Well, is that what happened in your opinion?
In my opinion, I'll give you my opinion on that. I wrote about it extensively back at the time. The Lehman collapse, in my view, was a sacrifice, and it was also used as a stealth recapitalization of J.P. Morgan.
Interesting. And the banks have just really, the quantitative easing programs, the Fed says in public that it's to promote employment, blah, blah, it's to blah, 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 help the real economy. But when you look at the balance sheets of the banks, like even the gobbledygook that they put out, which obviously is not GAAP anymore because the FASB, the Financial Accounting Standards Board, said that they can mark their assets at whatever model they want to, right? They can value their assets at whatever.
That means they don't have accounting. They don't have accounting.
They have
there is no accounting.
Yeah, they have Enron or Ponzi accounting. Yeah.
So I mean, I can tell you that my paperweight on my desk is worth $8 trillion, and if you accept that, I guess maybe you would lend me $5 trillion against it, then, wouldn't you?
Well,
I mean, it's ridiculous.
Yeah, that in essence is what's happening, right?
Exactly.
So then the QE programs, the bailouts, the TARP, this hasn't been to help Main Street at all, right? This has just been to keep the banks going so that they can perpetuate the government and all the spending policies and just maintain the status quo?
I'll give you the quick and dirty on why the debt has to continue growing. Debt is money in our fractional reserve banking system, and in the life of any fiat money system, which our current U.S. dollar hegemony system is, in any fiat monetary system, you reach an inflection point in the life cycle of the currency where there's an inflection where the currency or the amount of currency in circulation has to go vertical. We are on that part of the curve now. A person who's done a great piece of work that explains this very carefully or very, very precisely is Chris Martenson, and it's on his site, and it's called The Crash Course. I recommend anybody to go to Chris Martenson's website and look up The Crash Course on his site, and it explains how fiat money in its life cycle reaches an inflection point, and it doesn't matter what the interest rate in any system is, it reaches an inflection point where the amount of money in circulation has to go vertical. That's where America is now. That's why we're continuing to see, even though the Fed claims they're tapering, but they're not. And we see billions, hundreds of billions of U.S. securities showing up in the ledgerdom of the likes of Belgium, a country. In the last 3 or 4 months, Belgium has strapped on something like $200 billion worth of U.S. government securities. This is a little country that has a GDP of $465 billion. This is so absolutely asinine, silly. Sorry to use the word, but it's an insult to the word to even say it. It is so blatantly, fraudulently criminal what's going on in our monetary system. It can only leave one to shake their head in wonder when they understand what the import of these numbers really is. And yet Belgium is running a budget deficit and a trade deficit. They don't even have the savings to be able to afford those treasuries. So listen, Jason, insolvent countries can't bail America out. This is very true. Now, in terms of the London whale trade, J.P. Morgan and Jamie Dimon came out and said, blah, 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 whatever the losses were, the convenient excuse, and the mainstream financial media went along with it, just like how the mainstream financial media has not even mentioned the Belgium buying the treasuries once. I haven't heard it once. So what's your position then on what happened with the London whale trade? Was that a problem with the banks on a bad derivatives bet, or did interest rates go away that they didn't expect them to after they helped manipulate them? I can't really say for certain what happened with the London whale trade. It literally could have been a rogue trader who was off the reservation, who might have been hiding deal tickets underneath his blotter. It could have been that. In an institution like J.P. Morgan, the odds of that happening aren't very good, because the kind of heft that a trader is swinging and throwing around to lose that much money, usually, but I would almost say by definition, they've got people sort of looking over their shoulders. And I know this because I know it firsthand. When I was a broker of these products back in the 80s and 90s, I know that when traders had exceedingly big positions on, they had senior personnel from the institution or the bank looking over their shoulders on days when there was a lot of volatility in the market. So to be honest with you, that one's a little bit of an outlier for me. I don't know exactly what occurred there. I don't think we've been given really true goods on what exactly happened in that instance. But the one thing that's of note, and I think might be the most important thing to take away from this London whale thing, is J.P. Morgan has a derivatives book which has been, for at least the last 10 or 12 years, has been in excess of $50 trillion, and I think it currently sits around $75 trillion in notional. And to think that they've gone 12 years, and I think they've only had basically one losing quarter in 12 years with a book that size. The odds of that happening, Jason, I would say would be like the odds of you flipping a coin 100 times and calling it right 99 times out of 100, and then you lose once and you say, "See, I'm human." Yeah, unless it was a rigged coin, right, where it was both heads and you were tossing that and the person who you were playing against or had betting against you didn't even know that, right? I'll tell you something, Jason. Back in the 80s and 90s when we had real markets, I dealt with some of the biggest derivatives players in the world, okay? Specifically, one of my clients was the biggest derivatives player in the world, hands down. And I can tell you that I covered them for a good 7 years, and I don't think they probably ever had more than 3 or 4 quarters in a row where they consistently made money. And And doing this, if you're doing it in real markets, and if it's real trading, you're going to get the market wrong at times, and you're going to have losses. But J.P. Morgan did it for 12 years, and they never had a loss. That alone, right there in a nutshell, tells you that it's a rigged game.
Yeah, they probably did a lot of insider trading as well.
Well, the insider trading, in as much as their prime client is the U.S. Treasury.
And they're front running everyone with high frequency trading programs too, right?
Yeah.
They have that ability. But I mean, the real linchpin is when your trading desk is the conduit through which U.S. monetary policy is being expressed, you know before everybody where the next movement in interest rates is going. And it's a good thing, I guess, maybe that you do know where it's going, because when you've got a $55 trillion interest rate position, it sure helps to know where interest rates are going to be in 6 months.
Well, before we get into derivative, let's talk about the regulators and their failure in doing their job in 2008 when we had a collapse. A lot of these banks were doing a lot of illegal lending to people that had no job and had no assets, called ninja loans back then. And now, 2014, we have more regulation and more agencies regulating the financial industry, and yet the banks are back to what they've been doing during the bubble, the housing bubble in 2000. So let's talk about the regulators. And I know you know a lot of regulators. I know a lot of regulators as well, unfortunately, and it doesn't sound like they know what they're doing. So what are the regulators missing back in 2008 when we had the financial crisis, and why aren't they not acting now on the banks? Because we all know they're doing a lot of illegal activities right now.
Well, the cause of the financial crisis back in 2008 specifically was in the real estate end of things, specifically with mortgage-backed securities, where they took subprime loans and they packaged them. They basically took lousy loans and they packaged them into a mortgage-backed security, which they somehow got regulators to or ratings agencies to rate as AAA. You see, and that's what caused the financial crisis. Because in 2008, as that was actually in 2007, with the failure of Bear Stearns and their mortgage portfolios, where AAA rated paper failed. You see, and that was the first time in history that AAA rated paper failed. Like normally the way ratings on paper work is that if something's going to be downgraded, it gets downgraded. Something could go from a AAA to a AA, or from a AA to a single A. But in the history of financial markets, a AAA rated credit had never failed. And that's what happened in 2007. That's why the commercial paper market froze in the summer of 2007. That's why the interbank lending market seized in 2007, because people no longer understood what a AAA credit was. AAA means it's impossible, it can't fail. But we got a new paradigm delivered to us by a bunch of sleazy ratings agencies, like these people like S&P and Fitch. These people should all be put on trial. They rated stuff that they wouldn't buy themselves. They rated as AAA, and basically they undermined their own credibility. These people are criminals. That was a criminal act. And you see, when the market no longer knows or trusts ratings, nobody wants to lend. Nobody wants to buy commercial paper, because people are wondering, well, where's the next AAA rated piece of paper that's going to fail?
And the same thing happened, Rob, too, when Obama changed the rules and the United Auto Workers changed the rules during GM's bailout when the bondholders got screwed. So the bond market then, retaliated, too, with that, and the bond markets wouldn't lend. So you have all these regulators here. The regulators I know, Rob, and the stories I've read and the people I've talked to who live right outside of Washington, D.C., many of them don't want to work in their government jobs. They're looking to cash out. So they want to go work in those compliance departments for the banks, so they're not going to work that hard to police them as accurately as they should, because they're probably, when they go in there to the office to look at the banks, they're probably grabbing those employment applications looking to make 2 or 3 times as much money and go work for the banks.
Yeah, well, to call a bank's compliance departments compliance of any kind is another misnomer, because I mean, basically what it is it's it's where they go bury bones. It's very sad. It's a very sad, and the thing is, listen, out of these regulators and out of these regulatory bodies, all we ever get is the show trial where they'll go after a high profile person like a Martha Stewart or show trials.
But she's not a banking executive, and then you have the banks, right? They throw like a mid-level executive. Maybe the guy's getting like some hidden money in a Swiss bank account, or he's getting a hidden yacht or a hidden piece of real estate in another country, right, in order to fall on the sword.
Well, I mean, listen, like what payoff deals anybody's getting in any jurisdiction is far and above me. Suffice to say, they do occur, and probably with greater regularity than anybody really believes.
Now, okay, so sorry, Mo, go.
Sorry. I was just going to say, it doesn't help that we have a monopoly in the rating agency as well. So, thanks to the government, we have no competition in that industry. If we did, then we have other rating agency would rate the asset or the mortgage-backed security at junk, and no one would buy them.
Well, look at it this way. When Arthur Andersen was found to be complicit in helping Enron hide or conduct false accounting with their special purpose entities and all this nonsense back in the early 00s, Arthur Andersen was disbanded. They were shut down. And as far as I'm concerned, what should have happened in 2007, S&P, Moody's, Fitch, they should have all been shut down. They should have all been charged criminally, because they had a fiduciary duty to rate things accurately on their standing and on their merits, and they failed to do that.
Yeah, but our government, Rob, at this stage is so fascist, though. It's like an oligopoly, like Mo said. There's only 3 companies, right? Moody's, S&P, and Fitch. And the government doesn't want to break them up because the government only wants to deal with a couple entities, right?
I think it's worse than that, Jason. I think that the moneyed interests that own the banks have bought the politicos. They've bought the regulators. They own the media. That's why we don't get any accurate reporting on any of this. And these people have a stranglehold on the process. And I mean, that's what it is. The whole system is captured, and America's being milked.
Now, Rob, I want to transition to interest rates, because you cover derivatives and interest rates. You made a bold prediction in the last year or two. You said once interest rates got to 3%, you said they probably wouldn't go much higher. I mean, Ben Bernanke now has come out and said, surprisingly, maybe to some people, that he does not think we will see higher interest rates than 3 or 4% during the rest of his lifetime. Do you agree with him?
Well, as long as there's an American dollar, and as long as the U.S. Treasury in its current format is in operation, yeah, I do agree with that. I said it long before Ben Bernanke. I told people 5 years ago that rates, because I had people tell me in the financial crisis that rates would go up. And I told them, you're wrong, they're going down. They're going to be forced down, and they're going to stay down, and they're going to never come up. And you know what? And I've been right. And I've been very accurate on my interest rate calls. And interest rates are never going up because they can't. Specifically because the first entity that pays the worst price is the biggest debtor, and that is the U.S. government. And the U.S. government cannot afford to pay market rates of interest.
And we have the same type of situation. Japan's been doing this even longer than the U.S. has. Japan's been suppressing interest rates lower with their QE program. They've been forcing their banks to buy Japanese government bonds. Europe hasn't had to do it because the U.S. has been essentially bailing out European banks. do you think then that the U.S. government is going to have to continue to basically bail out all these different banks and governments then?
But you know what? Just keep that question fresh in your mind, because I want to just backtrack for a second. Comparing Japan to America, I don't think is a wise thing to do. Japan is a much different animal than America, and with Japanese government bonds being at the low levels that they're at, you can't really make the same case that it's just like America, because there is no yen overarching derivatives complex, on top of the Japanese yen. You see, American rates were forced down through the derivatives complex. There is no comparable derivatives complex in Japan, and Japan has cultural differences towards saving historically that differs from America completely. Japan is a nation of savers. America has never been a nation of savers. America is a nation of consumers. So there's a huge difference there. And through that lens, if you could please just rephrase your question.
Do you think the U.S. then is going to have to bail out Japan and Europe? Because in essence, the U.S. and the Fed have been recapitalizing European banks. Do you think they're going to have to recapitalize the whole system?
Well, I mean that's pretty much what they've been doing all along. You see, Jason, you can no longer look at the Fed's balance sheet in isolation. And you can't look at the Bank of Japan's balance sheet in isolation, because the interdealings between these central banks has become so complicated, so intertwined, and so twisted, because they've got these huge currency swap agreements between all the central banks. So you can't just look at. It's the same thing. We've got everybody in the mainstream media talking about the Fed doing a taper, and they're announcing they're doing more taper every month for the last 3 months. They announced the first round of taper in December. But, it was in December, the Fed announced the taper, and then suddenly you've got Belgium gobbling up all the debt. So, I mean, if the Fed's announcing that they're taking the taper out of one column, but they're really just stealthily adding it, into another column that they call Belgium, and even more so, there really hasn't been a taper at all.
This is a really good point. And Paul Craig Roberts and Dave Kranzler, I don't know if you saw their articles, but they showed that the Fed just added it onto another line item of their balance sheet with the loan, I guess, to Belgium, right? So Belgium can buy them?
Absolutely. Absolutely. I know their work very well, and I communicate with Dave Kranzler quite often, and he's a very sharp guy, and Paul Craig Roberts is quite a brilliant man and quite a patriot. So.
Yeah, we're friends with Dave over here. We've interviewed him a number of times, too. In terms of the interest rates then, so you don't think we're going to see any interest rates spike then in any of the key countries? So maybe a smaller country then will be allowed to fail that won't start a domino effect with some of the other countries, but the main countries like Europe, Japan, China, the U.S., those guys are all going to coordinate with each other now to suppress rates?
No, they're going to print their way to prosperity. And anything that does fail will be ring-fenced before it's allowed to fail.
So you think then that Deutsche Bank, which is probably the worst of all the European banks, it's a disaster because of their derivatives exposure, you think then that they'll just break it up into pieces like I've been predicting and Jim Willey has been predicting too?
There's been talk of that Deutsche Bank might be broken into pieces. I don't see how they're going to be able to do it. Deutsche Bank has a derivatives book bigger than J.P. Morgan's, and how you exactly take apart something that big, I don't know.
How did it get that big? Were they the suckers on the other side of the trade that the best Wall Street guys just dumped all this garbage on?
Well, the history of Deutsche Bank becoming involved in a really large way in derivatives, the history of it is when they were basically involved in an arranged marriage with Bankers Trust back in the late 90s, and Bankers Trust was a call it a pet of the Federal Reserve. Bankers Trust in the institutional markets was known as the Fed's bank, and that was a place where they housed an awful lot of derivatives. Bankers Trust had a huge derivatives book, and there are some people in the banking industry, and in the institutional universe, me included, that believe that Bankers Trust financial problems back in the late 90s was all due to their derivatives. Anyway, they were married off to Deutsche Bank, because I believe at the time Deutsche Bank was probably one of the best capitalized banks in the world that could actually swallow that nasty pill. So, that's when they more or less, I would suggest, when Deutsche Bank got mainlined into the big leagues of derivatives play, and they've been a big player ever since.
Now let's transition and talk about derivatives. There's a lot of reports out there saying that there's over $700 trillion worth of derivatives in the global economy, which is pretty scary if you think about it, and what happened in 2008 with the mortgage derivatives and the collapse there. And yet we're seeing reports that there's $700 trillion derivatives out there, and if you can imagine a collapse in that market and the effects it could do in the economy. And so let's talk about that derivative. Before the podcast, we were talking about interest rate swap. If you don't mind, could you explain to our listeners what those are?
Sure. Okay. The people talk about derivatives. There's a lot of misinformation on the airwaves and in print about derivatives. The derivatives, the places that actually keep track of derivatives, there's two benchmark places where you can go to look at the scope of the derivatives. And in an American sense, you go to the Office of the Comptroller of the Currency, and they publish a quarterly derivatives report, which gives the activity of American banking institutions and their derivatives activity. And then apart from that, there's also a body called the Bank for International Settlements, or the BIS, which is based in Basel, Switzerland. And they produce twice a year, a semi-annual derivatives report where they give the scope of global derivatives. But they don't break them down institution by institution. And in the derivative space, so when people talk about there being $700 trillion worth of outstanding derivatives, 80% to 81% of all outstanding derivatives are interest rate derivatives, specifically to do with interest rates. And then the lion's share of interest rate derivatives are composed of product called OTC swaps. OTC swaps are further broken down into two principal categories, which is an FRA, or a forward or future rate agreement, and IRS, which is an interest rate swap. And without getting into a whole lot of minutia about these products, let's just say that these OTC swaps are off-balance sheet credit instruments, and they synthetically mimic borrowing and lending, but principal does not exchange hands. Such as when you borrow $100 from the bank, they give you $100. But when you do $100 worth of interest rate swap, nobody gives you 100 anything, to begin the trade. So that's sort of a broad, sort of an umbrella of the interest rate derivatives.
And the interest rate swaps, Rob, are also where there's obviously a lot of counterparty risk, where one party is taking a variable rate risk that rates could go higher, and the other one wants the safety of a fixed interest rate, right? And that's how J.P. Morgan was able to screw over all these municipalities, right? Because they tricked them into thinking that interest rates would go higher, and interest rates went lower.
Well, an interest rate swap, Jason, has a few moving parts. An interest rate swap is also a credit spread, because interest rate swaps in the institutional universe, they trade as a spread over U.S. government treasuries, And then what they are in actuality, an interest rate swap is an exchange of a fixed rate for a floating rate. But there's in the interbank market, when banks trade interest rate swaps, they do so on spread, and there is typically an embedded cash bond trade in the when the trade is consummated. And that would be true on an interest rate swap of duration of 3 to 10 years. No. And trades under 3 years, there are interest rate swaps under 3 years, and they trade a little bit differently because what they trade against, or what they're typically hedged against when they're under 3 years, is a strip of futures, Eurodollar futures specifically, which is a LIBOR-based product.
Now, Rob, this sounds so complicated that someone working in the Treasury Department of a municipality part-time in a small city in the United States, there's no way they're going to be able to understand this properly in order to do a smart trade with someone as sophisticated like yourself who worked at a bank and did these things full-time. I mean,
Jason, I didn't work at a bank. I worked at a broker.
Oh, sorry, at a broker. Or... Yeah. Well, anyone then who worked with these things, whether at a bank or a broker, you guys are going to always be on the winning side of the trade, because the analogy is, at the poker table, if you don't know who the sucker is and you look around, it's probably you.
Well, it's, there's merit to what you just said, but think about it a little differently. I'll tell you something, Jason. I'm 54. I used to own a lot of houses when I was in my 20s. And I remember financing houses at, like 5-year mortgage rates at 10, 11, and 12%. And so like when I can remember double-digit interest rates. I was alive in 1980 when you could get 21% on a 3-month T-bill. And so I remember high rates. And people, for the most part, who'd be working in a municipality or in the treasury at a municipality, they're probably all old enough to remember higher rates too. So when Mr. J.P. Morgan banker comes along to them and says, "Look, I can sell you some interest rate insurance here, at cap your borrowing costs at 4% for the next 6 years," and how does that sound? That sounds like a great deal. Well, to somebody who's lived through 21% interest rates and high teens in the interest rates and has paid those kind of rates of interest themselves, that sounds like a pretty attractive proposition. But you see, what would be nice would be if J.P. Morgan would acknowledge to their customers that the bulk of their derivatives book, the other side of it is the U.S. Treasury. And it's the U.S. Treasury basically signaling that they're going to take rates down to zero and they're going to keep them there for a long time because they're doing 10-year interest rate swap trades with J.P. Morgan, which basically is the implementation of U.S. monetary policy through their trading desk. And so J.P. Morgan knows that the rates are going to zero. So they know they're going to fleece their clients because they know rates aren't going up. I mean, it's pretty simple business to sell something to somebody who when they're never going to collect on it. It's a sucker bet. I'll sell you interest rate insurance, guaranteeing that you won't have to pay more than X. Well, I know it's never going to be more than X because the guys who make the policy are doing stealth trades through my trading desk that tells me they're going to zero. But you see, we don't hear any of that, and the media and our lame media won't report it. But this stuff goes on every day,
and it's very unfortunate. Now, Rob, before we let you go, we talked about derivative and the Federal Reserve and the endless money printing that's been going on since the 2008 crisis, and especially QE, which it looked like it may never end. Well, what do you think about that? Do you think QE can never end? And what does this mean for the people on Main Street?
Well, will this ever end? That's a great question. The way I want to answer this is to say, when you're watching a great David Copperfield show and you say it's never going to end, the show ends. People aren't going to want to be fooled forever. People have been fooled, and people have been played for fools. And there are people in the world who are sick of being played for fools, which is why we're seeing a lot of, like there is a regulator in Germany, it's called BaFin. It's an adjunct of the German finance ministry. They're fiercely independent. And these guys wave a pretty big stick. And these are the guys that have had the heat on Deutsche Bank. And these are the guys, I would suggest to you, it's the BaFin investigation of Deutsche Bank, which is why Deutsche Bank has excused itself from the silver fix. And these people are putting the heat on Deutsche Bank in a big way. And if Deutsche Bank ever gets broken up, I think it will be likely at the direction and at the insistence of BaFin. And the thing with these banks, if there's any reality that's ever going to be brought to bear on them, if they ever have to have a real accounting, they'll all blow up. They'll go down like dominoes. And I'm going back to your question, will this ever end? At some point this will end, and it won't be pretty. And I just hope it doesn't end in a world war. So.
Well, more people are waking up, Rob. I mean, I don't know about you, but my grocery bill since 2005, it's way more than doubled. The gas price is up despite the shale oil boom. The gas price has come down a little bit since 2008, but it's starting to go higher again. All my insurance costs, my cable bill, my electricity bill, all the everyday things I need to survive all have inflation in them despite the government statistics. And we have a large global audience. We talk to people all over the world who message us and respond to our podcasts, like either on YouTube or in emails, and they tell us their bills are all going up and the government statistics don't reflect any of this. So we do slowly have people waking up, and I think people are starting to at least question the stuff coming out of the mainstream media, the stuff coming out of the U.S. government, the stuff coming out of Wall Street, who seems to say, there is no inflation, interest rates can stay at zero for forever, deflation is the great enemy, blah, 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 blah.
Well, you know what? We can't have enough of them wake up quick enough, if you ask me, Jason.
Now, my last question before we let you go is about the gold and silver market, since you also are an expert there and you worked with GATA for a long time. Do you think this London silver fix, do you think the paper market is eventually on the COMEX and the LBMA? Do you think that's going to go the way of the dodo bird, or do you think then that's going to be controlled then just like the interest rates and the derivatives have for a very long time to come?
In the precious metals markets, Jason, I believe that physical demand will trump paper manipulation in the end. And I think that the day when physical realities trump paper rigging, I believe that end is probably not too far away. It's really hard to time it and put a date on it, though. But I do believe I think I'm going to live to see it. Let's put it that way.
And that's a great point. I agree with you. I think the physical demand in gold and silver is going to overtake the paper market, and eventually the price is going to have to go up because it cannot stay this low forever. Because the demand is going crazy, especially overseas in the East, in China and India.
And the miners are all losing, a lot of them are almost all losing enormous amounts of money. So something has to give very soon. So either demand has to decrease or supply has to come offline and the price has to go way higher, because the current supply-demand fundamentals with the current prices is just, it's not sustainable.
Absolutely not. I mean, look, a lot of marginal production is being shut in and shut down, because the cost to produce a marginal ounce of silver right now, I believe, is in the low 20s.
Exactly.
So I mean,